A very good morning to you all. Welcome to the first lecture of Advanced Financial Management paper of ACCA. I hope all of you are doing well. We're going to begin this session and the entire journey with a quick round of introduction about ourselves. I'll go first and then I would request you all to share your introduction as well. So, I am Anushka Jain, CA and ACCA, and your mentor for the paper of Advanced Financial Management. To elaborate on my journey, I completed my CA in 2017 in by completing all the levels in the first attempt, and I started working at Coca-Cola in Bangalore. It was during this time that I developed interest in international accounting and financial practices. So I decided to take up ACCA. It was the middle of 2019. It is June 19 that I started this course formally. And ACCA's AFM, because I was a chartered accountant, I didn't have to go through the knowledge and the skill level. I was exempt from those papers. I had to just give the four papers at the professional level. So the first paper that I gave was AFM, and that is what I chose in June 2019. I got All India rank 1 and World rank 2 in the paper. Then next I chose SBR and SBL, which again I cleared in the first go. And finally, in December 19, I gave my APM paper, passed it, and done with the course. So it was by the 2020 that I started teaching as well along with my work. So I started AFM was the first subject which I started off with. So it's been now about 5 years that I've been coaching students in ACCA. And once I was done with this qualification, I moved my job. I moved to Pernod Ricard, India, which you might not know by the name of the company, but Seagrams. It's a liquor company. So I joined there, and post that I moved to Flipkart. Flipkart, I was handling business finance for fintech. Okay. So after about 2.5 years there in Flipkart, I again got a call back from Pernod Ricard, India, to head their finance team for the Northeast India operations. So that's how like my last stint was. And I got married recently. So I've left corporate now and I'm focused fully in coaching. So that's how the journey has been so far. And I am sure some of you might have studied from me earlier. I can see some familiar names. And that was from my side. I would love to hear from you. I would want to know your names I can see on the screen. I would want to know where you are from, where you are in your ECCA journey, if you have done any of the papers, or if this is your first paper, and any paper that you have already passed, I would want to know. If you are working, not working, and if you have studied from me before, please do mention that as well. All right, let's begin. All of you, please use the chat box functionality to message your answers, please. I see Ashwani has responded. It's a first paper. Okay. She's done CA. All right. Laksha. Okay. Done with SBR, awaiting results for SBR. Graduated 2 months ago. Laksha, in which of my earlier classes were you there? All right. Which subject? Oh, both FMPM. Okay. All right. Everyone, please send in your introduction. Okay, I see Vicky has responded. Vicky is from Delhi, done BCom, MCom, MBA, International Finance. Huh. Having around 4 years of experience and currently working KP engineer for the last 3 years. Very good. Shraddha is a CA, first paper, just enrolled for ACCA. Perfect. All right, very good. So on that note, we're gonna be starting with a quick introduction to the paper. Now that we know each other. Okay. So first, we should be aware of the exam format. I see a lot of you are giving the first paper in AFM. So you should know what the exam format is going to be like. So to be very clear, all exams conducted by ECCA are computer based. Okay. So AFM naturally is also a computer based exam. It's called CBE, computer based exam. Now the approach to examine is number one, there is no choice in the exam. You won't get any optional question that, okay, you go for this or for that. Every question appearing on the paper is going to be mandatory. and all questions have to be answered. There is no negative marking. So please don't skip any question. Okay. Exam duration is gonna be 3 hour 15 minutes and it's a 100-mark paper and you need to score 50%, that is 50 marks to pass the exam. Okay. Ma'am, is it something like 15 minutes is for reading or writing, something special about it? No, total 3 or 15 minutes are given to you. You have to manage the entire paper within it. Now, whether you read, whether you write, it's all on you. No one is prescribing that by ACCA at least. Okay. Now, when you are writing the paper, you have to adopt the role of a senior financial advisor. Now, from its day one, just imbibe it in yourself that you are at a senior position within a company. Okay? And that is how you should approach the problem. Then only you will get the best of the answers. You're not just doing some reporting, you are at a senior position yourself and you are driving the growth of a company. That is the objective, that is the perspective you should carry in your minds. Okay, so adopt the role of a senior financial advisor. And two very, very important areas. Number one is advanced investment appraisal. And number two is treasury and advanced risk management. Okay, so these are the two most important topics I would say. We are going to be practicing, of course, all the topics. These are some topics which I say you should have complete hands on, regularly tested in exam. So that's why I've mentioned here. Okay, so very quickly, what have we learned? 100-mark paper, pass mark 50%, and you have to adopt the role of a senior financial advisor. There is no negative marking, so please attempt the entire paper. So first we have section, now two sections. Now let's get into the layout of the paper. We have two sections, section A and B. Section A has got just one question. And that's a 50 marks. And one question of 50 marks, not one entire question. How you can interpret it is that there will be one scenario that will be of 50 marks and it will have many sub requirements of smaller marks. Okay, like maybe 8 marks, 5 marks, 2 marks also. So that's not specified. But yes, the entire question would be of 50 marks. And out of those 50 marks, 10 marks will be of professional skills. Ma'am, what are professional skills? We will be discussing that further. So, one question, 50 marks, and out of that, 10 marks is for professional skills. So 40 marks is technical skills that you have to display. You have to write formally for that. Okay. And this will be a report format question. It will be a report format question. That is, you'll have to write a report to maybe the CEO of the company, to the senior directors of the company. Then section B will have two questions, question number 2 and 3. First question of section B will, each of the questions will be of 25 marks each, and each of them will comprise of 5 marks professional skills. Okay, 5 marks of professional skills. So that's about the layout of the paper. Any doubts here? Anyone, getting any doubts? Don't feel shy. Just please make use of the chat box functionality. Type in your doubt and we'll cover it here. Okay, don't wait for the entire session to get over to ask me doubts. You can have two-way communication here itself. So anywhere you feel that you're not understanding something, just put it down in the chat. We'll take it up. Okay, so now we saw that 20 marks in total are devoted to professional skills. So it's very important to know what those professional skills are. So about 21 classes would be there, Ashwini. We'll be meeting over the weekends. Some practice sessions, if you have some doubts, some practice sessions Could be scheduled on the weekdays, but in the morning session, maybe like 7 a.m. to 9 a.m., just for practice purposes. But that will be on need basis. So, scheduled classes are weekend, Saturday, Sunday, 7 a.m. to 12 p.m., about 20 to 21 classes would. All right. Now let's see what the professional skills are. So there are total four professional skills. First, communication, then commercial acumen, third, analysis and evaluation, and fourth, skepticism. What are they? Communication, commercial acumen, analysis, evaluation, and skepticism. So, in the skill of communication, so when the question mentions, and let me tell you, section A will test all four of these skills. All four. Section A question. And section B questions, they don't test communication skill, they test the other three skills. Am I clear? So communication skill is tested in section A only, along of course with the other three. And in section B, A is, communication skill is not tested. So under communication skill, as I told you, if you remember, section A will be a report writing question. You'll have to write the report. So communication skill is, displayed in how you write that report. And does it include only the format, how I lay out the report? No. It's more about how you deliver the message. See, as professionals, communication skill is super important for you in your entire career. When you are, meeting with seniors of your company, or maybe some colleagues, or people outside the company, it's how you talk and how you deliver the message that makes all the difference. See, now, even when I am taking these classes, I am delivering what I want to do or what I want to convey in a certain way. Now, the same thing could be conveyed in different manners as well. But my objective here is that I am teaching a class, so they should understand the language I am talking in. If I start using some, technical jargon, it will all start going bouncing over your head. So every time that we are conversing or every time we are communicating, there is an objective to it. And you have to see that the objective gets fulfilled. And this I'm telling you, not just for your writing skills of AFM paper, but generally also I see this skill lacking in so many people. People have qualified and still they lack the basic communication skills. It is about delivering your point in the best manner so that the other person understands you. You are able to drive across the point. That's the whole game about communication skills. Okay. So, what you have to do? Inform target audience using clear format. Now that we are writing a paper, it all comes down to having a clear format. And in fact, I'll spend some time with you on how that format should be, right? But later, not right now. Then we have persuade with logical argument. See, it's not like you are a senior professional in the company and whatever you say is the law of the land. You should be able to drive your point with logical arguments. Now, let's take, for example, this class. I'm telling you something. One way is that, okay, I'll just hammer it in your mind that this is what it is. No explanation. I'll come to the class every day. I'll just talk the facts. Done. Another approach is I talk about those same facts, but I support them with some logical arguments. You will also remember them more because now you have logically understood things. That's what people love about the classes, right? That they are able to understand the points, not just memorize them, but understand why something happens. So that's what logical argument is. Now, when you write your report should also have logical arguments. Then, commercial acumen. Commercial acumen skill is showing practical consideration. That what you are writing is practical, something not theoretical that you have imagined out of your mind. Okay, so being practical in your approach, that's number one. Then recognize constraints. What are constraints? Constraints mean limitations. That it is possible that the approach that you have adopted has got certain limitations. So you will learn about capital asset pricing model, CAPM, to calculate the cost of equity. Now it has got certain limitations. So you recognize that in your answer. That will give you the marks for commercial acumen, that you realize that yes, there are some practical challenges in this model. Then awareness of alternative opportunities, meaning that there are some other ways to do something. It's not just there is one way. So for example, cost of equity itself. One way is to calculate using CAPM. Then another is dividend valuation model also, which can be used to calculate cost of equity. So there are different ways to calculate cost of equity. So awareness of those of alternative opportunities, that is also reflected in commercial acumen. Third skill is analysis and evaluation. First, consider the meaning of data. See, now you are at the professional level, you're no longer writing knowledge level or skill level papers, or if you are coming through the CA route, it's not some basic paper. You are at the professional level. So you are expected to analyze and evaluate the data, not just read it and repeat it in English words. That's not what evaluation is. You need to understand the meaning of the data, what its impact would be on different stakeholders, and that you're able to apply this analysis to the company. That's what analysis and evaluation skill is. That you have good analytical skills when it comes to data. See, in my roles that I have worked, I have always dealt with a lot of data. You know, that skill, it develops over time, that you learn how to see data, because otherwise it's just numbers, but then to drive or derive stories out of it, that okay, this is why it is showing this trend. Okay, why there is a certain pattern to it. So all of that comes under analysis and evaluation. Lastly, skepticism. Question the validity of approaches. Having a skeptical mind, I'm sure this you must have heard before also, that as professionals, as finance professionals, you need to have a skeptical mind. You need to have a questioning mind. Why is something the way it is? Or why this approach only? Why not the other approach? So that should also be reflected in your answers, and it carries marks. See, I'm telling you, all these four boxes which we are discussing, total they are carrying 20 marks. And there is no specific chapter to it. So it's all about how you are writing the balance 80 marks of your paper. By showing these skills is what will get you the 20 marks. You don't have to write anything special for these 20 marks. The entire balance 80 paper, how you write that by displaying these skills is what will get you those 20 marks. So be very careful. Again, there will be no chapter to it. I'm telling you, this is the entire discussion we have on professional skills. You will, of course, develop these skills of all these skills together, but there will be no special chapter to it. It's just how you write the balance 80 gets you the marks for these skills. Okay, so having a questioning mind is the skeptical mind. You might need to mention that, okay, so and so information is missing. It would have been better to arrive at conclusion if that was also available. Okay, so these are the four professional skills that you should be aware of. All right. So now coming to the skills required. First and foremost, very, very important, all of you will please attend the classes on a laptop or a desktop computer only. No mobile phones, no tablets. I'm very clear. See, you are also coming to the exam, to the classes to pass the exam, and I also equally want you all to pass. So it's a sincere request. Anyone who is joining on mobile or laptop, it's not going to help you. You will need to practice the questions which I give you in the class on Excel and Word. Only then you'll be able to pass the paper. So be prepared for that. Okay, so entire practice, whether we have it in the class or when I give you homework, you will do it on Excel. And see, I'll tell you how you're gonna do it. Every time we start a new chapter, create a new Excel file. Okay? Create a new Excel file, and for every question that you practice, create a new tab in that Excel file. And when I give you homework, the backside questions. So we are going to be studying from the VGLD book. So there are questions in the backside, chapter wise. So whenever I give you questions for practice from the backside, create new tabs on that Excel sheet and start practicing like that. So by the end of the syllabus, you will have one Excel file for each of your chapters, which will have the answers in that in Excel format. So you're able to practice also, and you develop like you would have your notebooks, right? Now instead of notebooks, you're having Excel workbooks. Sorry about that, I've got a very bad cough. Okay, so that is practice questions on Excel and Word. You'll have one Excel workbook for each chapter. Then one idea per mark, quality over quantity. Very, very important statement. I keep getting this question from students till the end of the syllabus as well. Before the exam, they'll ask me, how much should I write? There is no quantitative length which ACCA prescribes. It's all about quality over quantity. You have to write one idea per mark. So if it's a 5-mark question, ideally you should write 5 unique points. You should write 5 unique points, and each of these points should be elaborated by up to 3 sentences. That's the suitable length for each mark that you write. So basically 3 sentences per mark. Am I clear? This is the expected length, and it's not about writing lengthy answers. It's okay, you write 2 sentences also, it's fine. But as long as you are able to discuss your point, you're able to explain your point, it's fine. So 2 to 3 sentences per mark, and each mark should be justified by a unique idea. Unique point should come out. Now, it may so happen it's not possible that for every time you have, like for a 5-mark question, you have 5 unique points in your mind. That's also possible. And it's fair. You might just get 3 or 4 points in your mind, but then just elaborate them much more properly. Okay? So that's what your approach should be, because see, it's 100% you have to write the answers. There's no objective test questions. You have to write a constructed response. That's why it's very important to understand the second point. Then, third is use headings and paragraphs. A key to score marks at the professional level is to write in headings and with headings and in paragraphs. What I'm trying to say is that, for example, the question is, what is the criticism of the capital asset pricing model for 5 marks? The suggestion would always be to write 5 points, and then how do you write that? In 5 different paragraphs, small paragraphs. See, I told you that 1 mark should carry about 2 to 3 sentences. So that is what will make up your paragraph also. 2 to 3 sentences per paragraph. And write a small 2 to 3 word heading to it, if possible. Okay, and when you write like that, your answer quality will be superb because the examiner can see what points you have written. You have written 5 unique points. They understand that, okay, each of these points are talking about this from the subheading. So that should be your approach. Use headings and paragraphs. Then label and cross-reference workings, very important. See, especially for the AFM paper, I would say the solution tends to be very long. You'll have to do multiple working notes. So always remember, you need to label and cross-reference the workings. Okay? That for a particular thing has been discussed in a note, particular calculation has been done in note number 2, note number 3, whatever it is. Like that. Okay? And you'll be learning a lot of formula. So you have to use those formula. Okay? Just 1 second. Huh? You have to use those formula in your answers. These are the skills that you need to know to pass the paper. Anyone getting any queries, please just put it in the chat. I'll not keep repeating this again. I want you to know that it's an open class. Those who have studied from me before will already know this. Keep it away. Any doubt that you get, just put it in the chat. Don't shy away. What will ma'am think or what will other students think? It's your class. Take advantage of it. All right. So time allocation. We have got what? 3 hours 15 minutes. What I would suggest is in the first few minutes when you start the paper, skim read all the questions. Ma'am, when I say skim read, what does it mean? It's not like you're reading the question in detail. Just glimpse of what topic has got tested in each question. Okay, what topic got tested in each question? That is what you need to understand in the first few minutes. See, this 15 minutes is on a higher side only. Try to do as quickly as possible. How quickly you can read depends on you. I read very fast. So for me, it's just a 5 minute job. So you have to first spend your time in understanding what topic got tested. Okay? What topic got tested, that is what you have to identify. And then, so for example, first question has tested on risk management, second one on investment appraisal, third one on business valuation. Your core area is investment appraisal. So go for the question which is testing your core area. That is the best topic that you know. You should go for that question first. It will give you confidence that, okay, so and so marks are surely in my kitty now. Okay. So first few minutes, take out some time to skim read and identify the topics which have got tested so that you can appear the question which tests your favorite topic first. Okay. Because you can answer the question in any order. No one is going to see whether you attempted question first or third question first. You can attempt the questions in any order. So approach should be to attempt easier ones first to make yourself reach a comfortable spot with marks. And to allocate your time, multiply the marks for each question by 2.25 minutes. See, how did this 2.25 minutes come? Very, very critical to understand. See, you have total 100 marks, but 20 marks are what professional skills. The balance is what 80 marks. Total 180 minutes is only I'm taking because first 15 minutes I'm taking out for reading. Ideally, you should take less time in that, but on a safer side, I've taken out 15 minutes. So you're left with 3 hours. So 3 hours is 180 minutes. 180 by 80, it's 2.25 minutes. But be careful. It is 2.25 minutes per mark. But in that, you also have to read the question. And I'm telling you, the questions will be lengthy. Okay? So you have to manage the reading as well as the writing, thinking part also within this time for each mark. Okay? Vicky says, do we have to update Excel working in report writing or only reference is sufficient for Excel working? No, only references would be fine. You would be writing the report in a word processor format. And so, for example, you calculated something in the report, in the Excel part of the report. You can cross-reference it, like by mentioning in bracket note, so and so, or refer appendix 3, refer appendix 4, like that. You don't have to elaborate too much in Excel. Excel is just for calculations where like 1-2 liner explanation in Excel, that's the maximum you would do. Elaboration would be done in word processor. You'll be getting two types of answer files, word processor and Excel. Did you understand, Vicky? Perfect. Yeah. So 2.25 minutes per mark. Be very careful. This includes your reading time, detailed reading time of the question as well. So total section A should take 90 minutes, 2.25 into 40. And each question in section B should take 45 minutes. And I'll tell you, stick to this time. So when you attempt section A, complete the entire solution, reading, writing, everything in 90 minutes. 90 minutes is 1.5 hours. Your time gets over. Please move to the next question. Do not overspend time on any one question. You're eating away the time of some other question which could have given you marks. So if you give extra time to any one question, it's not like they will give you 60 out of 50 marks. You will get maximum 50 only. But if you don't move to the next question in the right time, you will not be able to finish the paper and then you lose out on marks which you could have scored easily. So stick to the time, move to the next question. Later, when you're able to save some time towards the end, come back and complete it. But don't overspend time on any one question. Just because you're getting stuck somewhere doesn't mean you have to devote all your time and energy to it. And all these things which you're seeing over here, time allocation, you will be doing it not for the first time in your real paper. You're going to be doing it in mock papers. See, I'll tell you what, and now listen to me, all of you, listen to me very, very carefully. I'm telling you something very important. You will be following this strategy throughout your preparation journey of AFM. So we are starting with the classes now. There will be about 20 to 21 classes, right? So our classes will be running till November. So just let me open up the calendar. You can also open up the calendar along with me. So your exam would be on 5th of December, right? Your exam would be on 5th of December. And mostly your classes would be there till 22nd of November. Okay. So you will get about 10-12 days for yourself for just last few days only for just studying. Last minute revision. Otherwise, you're gonna be spending the entire duration with me. Every weekend we'll be meeting. Ma'am, should we not study during this time? You can see for yourself that will be a blunder. You'll not get any time to revise later on. So what your strategy should be that every time that we are covering a chapter, we complete a chapter. So there will be Total 18 chapters that we're going to do. Big and small. Some will be small, some will be long. So total 18 chapters is what we are going to do. After we complete every chapter, please revise it in entirety at home during the week. Okay? Don't keep things towards the end. You will be in for a blunder. So revise the questions which we are doing in the class. Any homework question which I give, do it as I've mentioned to you in your Excel files, and revise the notes. See, I'll be giving you the note. You will of course have the VGLD book, and the notes I will give you in the Excel format only. So what I do is once every chapter is over, I create chapter wise files. I don't give class 1 file, class 2 file. I'll be giving you chapter wise files. So once each chapter is over, you will get the final file from me, which will have your notes, the class questions, discussions, okay, and the solutions are also there for the backside questions, which may or may not have been discussed in the class, but mostly I have provided the solution in the Excel file. So once the chapter is over, you need to practice it. Okay, you need to practice the questions at home. You will have the aid of my solutions in the Excel file. If you understand it, good. Don't understand it, please note down your doubts and ask me in the next class. We will take it up. I'm again and again repeating this, considering it's a first class, so you may not be knowing this, but I try to keep the class very engaging. You can ask me any type of doubt that you have. That's the best way to learn finance. Otherwise, it's not a subject which I can tell you, okay, learn this and it's done. You will need to practice, and you may get doubts while you practice. So just go with that stride that I have to keep revising along with the classes. I'm not going to wait till the end. There will be no time left. All right. So coming back, what you have to do. So your first revision, I'm talking about revision only because learning part you will do in the class. So your first revision would be happening along with the classes. After each chapter is over, next 1 week, devote it to revise it. Okay, if it's a longer chapter, maybe 2 weeks, but that's too long. But just keep this in mind that okay, one chapter is over, I need to cover it in the next week. After that is over in the classes. Then slowly, gradually, what will happen? See, there are a lot of chapters. 18 chapters is a long journey. You might start forgetting the things that you've learned in the earlier chapters. So what you should do is do a rolling revision. So it's possible that in a particular week, no chapter got completed. So you will go back to the earlier chapters and revise them. So in this way, your 2 rounds of revision, first will be of the specific chapter after a chapter is completed in the class. In the week after that, you do its first round. And on a rolling basis, you keep on revising the earlier chapter. So 2 rounds of revision get complete along with the classes. Are you able to follow me? So 2 rounds got completed. So the last 10 days, 12 days that you get before the exam, that will be to do the third round of revision and solve mock papers. Ma'am, how will I revise entire thing in 10, 12 days later? See, I'll tell you a strategy there. When you go for the first round of revision along with the classes, you should highlight the topics which you feel are difficult. You should highlight the questions which you feel are difficult, which you are making mistakes in. Mark those points. Okay? Mark those points that, okay, I'm struggling with this. May not be the entire question, some part of the question that you're struggling with. You're not able to do a particular adjustment properly. So that is what you do in the first round. So it's possible that out of the total 100 questions which are there, you are able to solve 20-25 questions perfectly on your own. Okay. So first is like that. Okay. So you highlight those questions which you feel you are having a problem with. So out of 100, only 80 will now be left. Then you move to the second round, the rolling revision, which I'm talking about. In this, you will just practice the 80 questions or those 80 points that you have highlighted. I'm talking in total, okay? So 80 now are left. So out of that 80, maybe this time you have highlighted just 50 questions where you, this time you struggle again. Just 1 second. Okay. So in the second round, what you will do is highlight more of such questions where you are making mistakes. Now, out of that 80 questions only. So out of that 80 questions, you will now be practicing, let's say 50 questions. So that's your second round. So do keep on highlighting these questions in every of these revision. That, okay, these are the questions I want to try in my next revision. So when you do the second revision, out of those 50 questions, you will highlight, have some, limited more questions only left for the final round. That's how your time consumption comes down. And of course, with practice also your time consumption will come down. On the same question, maybe earlier you were taking 35 minutes. You will now, with the second revision, you will take 30 minutes, later on 25 minutes. So anyways, your time consumption will also come down. And the quantum of question also, that would come down. Because the number of mistakes that you will do will gradually keep coming down. So that's how you have to approach the preparation strategy. What is it? So first of all, first round of revision after each chapter is complete. Second round, during those weeks where no chapter got completed, so you have time for a rolling revision. Okay, earlier chapters. And thirdly, third revision in the time before exam. So these are the three revision that you're going to do. And lastly, you are gonna go for mock papers. And I suggest to go for minimum 3 mock papers so that you are well prepared for the real exam. The real exam doesn't come as a surprise to you. Okay? So that's your strategy. Ma'am, where are we gonna study from? All of you are gonna study from the VGLD book only. I'm making it very clear, no other publication would be needed. Please save yourself from wasting time by referring to different materials. The entire syllabus is same only. It's just that the question name could be different, question numbers could be different. The VGLD book is exhaustive, so students are doing really well. So don't have to do any other book. Just VGLD book should be fine. No BPP, no Kaplan, nothing is needed, I'm saying. And also entire study part and the practice part from VGLD book only. I will be giving you notes for easier understanding of the topics. These two will be the only areas which you will study from. So your source would be just these two, the VGLD book and the class notes. Nothing else would be required. Question practice again from the VGLD book only. Study Hub is covered in the book. So you won't need it. I'll just show you that as well. So it's covered in the book. You will not need to cover it separately again. And mock papers will be available on the platform. Again, that is also something I'm going to show you just now. Okay, so let's move to that only. So those of you who have not opened mock papers or the study hub till now, you can follow these steps along with me. Open your browser and type in ACCA Study Hub. First, I'll give you a glimpse of the ACCA Study Hub. So if you scroll down, you will see this alternate login. So enter your username and password. So type in ACCA Study Hub, click on the first link that you get, scroll down, alternate login, and when you click on that, you will be asked to enter your username and password. Okay, so you enter your username and password. Follow the steps along with me so that you are also able to access the study hub. So you'll be able to see different courses here. So for you, you need to check your AFM paper. You'll have to go to the not yet started tab. Okay. And you will see this for exams from September 25 to June 26, AFM. You click on study. And once you click on study now, that tab will now start showing on the dashboard. So every time you don't have to search so much, it will now start showing on the top of the dashboard itself. So in this way, see, you will see the content over here, chapter-wise content. And then you have flashcards. I'll not say a very important element because it has got just one word definition to important terms. Because at the professional level, you'll not be able to, write down definitions per se, but just for our understanding also, that's fine. Like for strategy, what's the meaning of strategy? A plan of action designed to achieve a long-term organizational goal or aim. What is money laundering, sustainability, sustainable development, so on. It's a long, long list. I'll not say very important, but if you yes, you want to have a quick reference to some keywords, you can refer to it. You have the option to print it. See, you have the option to print it. So yeah, you get this as the first layout. If you click it on view list, you get it in a list format which you can print. Then you have a quiz section, chapter wise quizzes there. So although short questions are not asked, but you may get some good questions just for revising a topic. So this is something you can uh, practice. So 5 questions per chapter would be there. And these are all objective tests, but let me be clear, there will be no objective test questions in your uh, exam. So randomly, I'm selecting right now. So you saw, you'll get a review of the answers as well. So what is the correct answer? You get that here. And the explanation for it as well. Okay, I had selected D, so that is incorrect. The correct answer is B. And this is the explanation. Now let's move to the next question's explanation. See, I randomly selected, it turned out to be correct. So this is B, and the explanation is given to you that it is driven by operational gearing, not financial gearing. You may not understand it now, but in this way, they give you the explanation. So question number C, the answer, question number 3, the answer is not C, it's B. And why it is B, that is also explained here. So in this way, you can attempt the quizzes. So this is one that we had attempted. So, okay, you can review your answers here by clicking on review all. You can reset it also. Like if you want to appear it later, that's also possible by clicking on reset test. You'll be able to reset the progress that you have here. Chapter-wise quizzes. Then you have practice session. Now, these questions are long questions. Okay. But these questions, these are all past exam questions, which are already included in your VGLD book. That's what I was telling. Now it is already included. So these are all past exam questions. Some of these questions I remember I did during my practice time also. And these are those, old questions. Okay. So no, nothing to practice from here. Quiz you may do, right? So that's all about the study hub. So you get chapter-wise content here. You can click and study, but again, as I told you, just refer to the one book. Uh, the layout, structure of the syllabus is same. So just go with the VGLD book, and that should be sufficient. Then next, what you need to know is how can you practice exams? So type in ACCA practice platform and click on this first link, past exams and question practice. And click on this, log in to the practice platform. Okay. So when you click on the, sorry, when you click on that practice platform, this is what will open up for you. You may not be seeing anything over here. Relax. I'll tell you how to do that. So what you have to do is click on browse available exams. Okay. And you select the paper. So for us, it will of course be AFM. Click on AFM and just click on view assignments. Sorry, one second. You click on AFM and then you see the assignments over here itself. Don't click on anything. It will just disappear these. So you can see the different practice exams. These are September, December 2024 means this is a past exam. Again, it's written also here. This is one practice exam. It's a specimen exam. Again, past exam. So like that, you will see variety of papers in front of you. 3 into 4, 12 papers for practice. And before every exam, they release one mock paper. So you can see this is pre-September 2025 mock. Once it is mid of November, this will go from here and you will start seeing pre-December 25 mock exam. They will update the paper and the solution, of course. So in this way, this is one quest paper which you have to practice, like the pre-December 2025 mock, when you will be appearing for the December exam. Okay. And other papers also you can practice. You can choose any two more. But bare minimum 3 papers is something that you have to practice. Okay. And I'll show you how that's going to look like. So for example, let's practice this one only. You click on assign, or let's take up any paper for that matter. Let's take up this one only. September, December 24, past exam. I click on assign. Okay. Now, once I click on assign, it will show me a pop-up, assigned. Then where will I see it? Click on view assignments. And it will start showing over here. See, earlier I had opened mock exam, so that was showing. Now I opted for this September, December 24 mock exam. So you'll have to click on start. Yes, start exam. It will take some time to load. How much time to take source? Let's wait for a couple more seconds. Here it is. So you'll have to click on next, giving you an introduction of the exam and how the workspace is going to look like. So it's giving you the exam summary we have already covered. That section A will have 50-mark questions. Section B will have 2 questions of 50 marks each. See, this is the question. So in this way, you will get the exhibit. So I'm telling you how a computer-based exam is also going to look like for those of you who have not given an exam on computer till now. So this way you will see the question screen, and these are the exhibits. Okay, this is the exhibit. Okay, you'll have to read through, different lot of exhibits would be there. It's a section A question. It has to be lengthy. So this way on intra-group netting and currency futures hedging. So this is from risk management chapter basically. Okay. This way they have given you this data, futures data, collar data. Sorry. Collar data and some details of a new subsidiary. So these are all 5 exhibits. Now, what are the requirements? Look at this. As I told you, the first question will it will always be a report. So prepare a report which now This report will contain these elements. Part 1, 2, 3, 4, 5, 6. 6 elements of the report. So first one is discusses the issues affecting so and so, blah blah blah, and then all these things you will of course learn. And then professional marks will be awarded for the demonstration of skills in communication, analysis, evaluation, skepticism, and commercial acumen. All the skills that you learned about gets tested here, and that's gonna be for 20 marks. Okay. So that's how a question would look like. Ma'am, where would we answer? See this. So as I told you, you'll get two categories of answer script. One will be word processor, another will be spreadsheet. Spreadsheet is nothing but Excel. But yes, it's not advanced Excel, very basic Excel format. So in this way, here you can write report to the senior, whatever it is I'm writing randomly right now. Management, not me. Your basic shortcuts work, like I pressed Control V and it got bold. I can do Control U, underline. Then, okay, if I press Enter, I remove the bold and the underline. This report talks about. Okay, in this way, you can write your report here. You can change the alignment, you can insert table if you want to write something in tabular format. Maybe a last conclusion. So this is something you can insert here. And bold, italics, underline is there. Strike through you will not need. Strike through is if you want to cancel out any word. Rather than canceling, you will delete the entire word. That would be better. If you want to make something subscript or superscript, again, not very useful. Then I guess that's pretty much it. You can, of course, copy paste also. Like you can copy paste from the questions exhibits also. Let me show you. See, sometimes to save time, you might need to copy some data from the question. In this way, let's have selected this. Control C, I press. Control V. Okay, so this report talks about Notney Company, which is a commercial vehicle manufacturer based in the United States. I wanted to use this statement maybe. So I can copy paste from the question. Save your time. See, you have these liberties, and that's what I'm telling you, that you should be aware of these things from the day first itself. Okay, so you have the option to copy paste, and you have a scratch pad here. Now, very important thing that I want to discuss here. See, there are two ways in which you can write your exam. One is you go to a center and write your exam there, or you can do it from the comfort of your home, which is a remote exam. So one is center-based exam, other is your remote exam. In a center-based exam, like you would have done across your educational journey, you go to a center, you write your paper there, it's done. But now instead of writing a paper, you will be typing a paper, right? Because it's a computer-based exam. So they will give you a desktop. You go there, you write your paper on a computer and submit it and done. The other option is that you write the paper from your own home. It's called a remote exam. There will be online video invigilation. You'll have to keep your camera on at all times. The invigilator will be watching you. And you can write the paper from your home. So that's also possible. Now, something that you should know, in a center-based exam, you get rough sheets if you want. You can ask for rough sheets from the examiner. In remote exam, you will not be allowed to keep anything on your table. Nothing would be allowed. If you are found to keep something, you will be barred from the exam. So for you, if you want to do some rough writing while you're reading the question, if something comes to mind that, okay, I want to incorporate this in my answer, you can make use of Scratchpad. See, Scratchpad will be available even if you go for computer-based exam, but you have the option of a, physical pen and paper there, so you can make use of that rather. But in a remote exam, you will not have any choice. You will just have a Scratchpad to yourself. That's where it comes very useful if you want to scribble down something. Am I clear? Now, whether you want to go for center-based exam or remote exam, I will leave it to your judgment. There are pros and cons of both of them. So you can so I have also made a video to it. I have a channel to myself, goes by the name of Anushka Jain, CA and ACCA. So I've made a video on how you can choose between remote and center-based exam. Basically, it's about whether you have a good internet connection, uh, or or you're okay with a you know s- unknown computer. Because see, when you are working, you are used to your own computer and laptop. You might find comfortable typing there. See, everyone have their own pace of hands when it comes to their own laptops. So all of those things I've covered in a video. You can check it out. But I leave it to your judgment what you want to select. 40 to 50 words per minute typing speed is fine. See, again, as I keep telling you, it's not about the quantum. Of course, you have to write the reports. It's not like you can just write down one or two paragraphs, it's done. It is always more and more about the quality which you display in your answer. So always keep that as top priority. But yes, to answer your question simply, 40 to 50 words per minute, is it fine? Absolutely fine. Okay. Yes. So uh, this is something that I wanted to talk about, remote versus computer-based, center-based exam. Now moving on. So that was a word processor answer sheet. Here you have a spreadsheet, simple Excel. You can do your calculations here. Let's say your uh, just like a simple Excel works. Cash flow, one, two, three, four. You can cut paste, Control X, Control V. Okay, so that ways. You cannot merge cells. Let me be very clear. You will not be able to merge cells. You can resize the content. I mean, this one column and row width. You can resize that by double clicking. If you want, it will auto fit, or if you want to do it of any specific width, you can just drag across like you do it in Excel normally. So that option is available. Then you have the feature to put color in a particular cell. You can do that. If you want to highlight a particular cell, you can make use of this. So like this, you can color. Then bold, italics, underline is available. Cut, copy, paste functions will work. You can change the alignment. You want to write something in percentage form. Best thing is to write it like this, 40 percentage. You can press shift and 5 on your keyboard, it will work. 40 percentage, you can write something in percentage form, but you have the option convert into percentage here also. Okay, so that is how a basic spreadsheet function will look like. There are some format cells option also available. Okay, like if you want to format it in any particular date format or something. That is a that is available. Then alignment I've told you. And here you will see a wrap text function. So you can if you write a very long sentence and you want to wrap it, you can click on this. And border function is available, but I'll not say it's very useful. You already have cell borders here. No need to make special borders. It will just take your time, doesn't give you any marks. Okay, so if you want to make borders, you can do it. However, not very important. So this is how your spreadsheet will look like, both word processor and spreadsheet. Am I clear? Anyone having any doubt, please ask. Anything, please let me know. Okay, in this way now, you can go to the next question also. Section B. See, it's a section B question, so the exhibits will be less. It's a 25-mark question. So 3 exhibits, requirements for 25 marks. Again, the response options are there. Again, similarly. Right? So once you're done with the paper, you click next. You click on next and they will tell you that, okay, this the question has not been attempted. You may have to relook at it again. So you can do that. And once you are done, just click on end exam. It will ask you again if you're sure that you want to end the exam. Click on yes. Yes, again. And your answer is done. Your exam is complete. Okay. So that is how a mock paper can be practiced. In this way, you can practice any of those 12 papers which you were seeing on your screen. Okay. Ma'am, how can I see the answer? So again, this is something I've covered in my channel also. Just top of the content only you will find it, because the layout got changed recently. So those of you who may have seen the answers earlier, the layout of how to see the answer has changed, but I'll just give you a quick glimpse. Once you click here, see this option will start coming to you. Mark exam. Now once you click on this now, you will start seeing the answer to it. I'll show you how. See what I wrote is coming over here. Right? I've written this. Now what is the answer? If you click here, you will get the answer. Sample answer. See, this is the answer. Report to the directors of so and so, introduction. And as I keep telling you, write in paragraphs. See, paragraph answer with subheadings. You click on this. Workings are done in appendix. This is the answer to question number 2. Question number 3. And this is the marking scheme which the examiner has. So Yes, if you ask me, is there step marking? Yes, you get step marking because this is how the examiner gives you marks. If you have done something correctly, you will get the marks for that. Ma'am, if I've done a calculation error in the in the middle, you will still get marks if your follow on approach is fine. Okay, so this is how you can uh, find out the answers to the questions. All the answers are available for all those 12 papers which you were seeing. You will be able to see the answers also in this way. So make sure you attempt 3 mock papers before you go for the real mock exam. All those time management skills and everything that we have covered, it should not come as a surprise to you in the real exam. You should be well versed with it during the mock preparation itself. Okay, so that's about time allocation. And lastly, question verbs. You saw right when I displayed one of the questions to you. One some question had, demonstrate, calculate. So these are all called question verbs. This is just an illustrative list of the different question verbs, and it's very important to identify which question verb means what you are expected to do. If it is asking you to calculate, you just have to calculate. If it is asking you to discuss, you just need to discuss. So don't start doing random things without seeing the requirement carefully. Always pay attention to the requirement. A lot of times, what happens, students see a familiar question, they jump at the sight of it, and in the excitement, they forget that the requirements could be different. Please read the requirement carefully in exam, always. Okay, so if you're asked to advise, this is just a recommendation of what your suggested answer should look like. You need to tell someone what you think they should do in a given scenario. That's what advice is about. Then analyze, that you have to break down the issue into multiple parts. You'll have to analyze the data, apply, put a concept into action. So you'll be learning a lot of models and all. So you may need to apply a model into some working. Then assess, judge the importance of an issue, discuss, argue about the pros and cons. Then estimate. Estimate and calculate is same. Calculate an approximate value, mentioning any assumptions if you have taken. Evaluate, balanced discussion of right and wrong. Explain, make a concept clear as if you're doing it for a layman. And recommend, which is same as advice. You need to suggest a course of action. Okay. So be very careful when you are reading the requirement and observe the question verb carefully. So that was the introduction to the paper. Anyone having any doubts? So all the files that I use in the class now, I will share it with you. So don't worry about taking screenshots or anything. You will get all the files. Okay. Excel also, like this PPT that I've showed you, that also I will share across. So we are going to be starting with chapter 2 today. Have you got the books? Okay. So, so role of financial study chapter 1 we'll be doing later. Today we are starting security valuation chapter. So you'll have to come to page number 22. Okay. I'll take you to Excel. So, sorry. We start with the perspectives of market efficiency. What is the name of the chapter? Security valuation and the cost of capital. What do you mean by security? Different instruments could be equity shares, bonds. These are all securities, right? Now, these are all tradable in the markets. Equity shares are traded in the market, right? So you need to understand the perspectives of market efficiency, how efficient the market is. Okay. And the efficiency can be assessed in several ways. So first one is allocative efficiency, then operational efficiency, third informational efficiency, and lastly pricing efficiency. So what is allocative efficiency? Allocative efficiency refers to how well financial markets direct capital to most productive and efficient users. And what does it mean? See, in the markets, it's not like every company gets the funding that it wants. You might have seen a lot of times the issues they go unsubscribe. Because investors are not willing to put their money in those companies' stock. So allocative efficiency, it refers to how well financial markets direct capital to the most productive and efficient users. It ensures that funds flow to the companies with the highest potential returns. If a market has good allocative efficiency, high performing companies they get the funding, they get the flow of capital. Example, a startup with a groundbreaking renewable energy solution secures venture capital funding, while a declining coal based company struggles to attract investment. Because we all know that the world is moving to a sustainable future, so coal based companies they will not get the funding. So the market is efficient because it allocates resources to a company contributing to a sustainable future. Okay? So that is the allocative efficiency of market. That market is giving the funds to the company which needs it the most. Then operational efficiency. Operational efficiency focuses on minimizing transaction costs and ensuring seamless trading. It ensures that market participants can trade securities quickly and at low costs, fostering liquidity and high trading volumes. Now, see, all of you, or some of you may have traded on the stock exchange. You will know that there are some transaction costs and fees which apply on every transaction that you do. If the cost is too high, don't you think it will deter the market participants from participating in the market? It will, right? So operational efficiency of market, it focuses on minimizing the transaction costs so that the market participation is active. Okay. So stock exchanges like NSE and BSE have advanced trading systems that allow millions of transactions to occur per second with minimal transaction fees. This enhances the operational efficiency by reducing the cost and time associated with buying or selling stocks. Okay. So operational efficiency is about minimizing the transaction costs. Then third, informational efficiency. Now, informational efficiency refers to the extent to which all relevant information, this is super, super important, everyone. What does it say? Informational efficiency refers to the extent to which all relevant information, which could be past information, public information, or insider information, is reflected in the stock prices. Example, if a publicly traded company announces record profits, its stock price immediately rises to reflect the new information. If you follow business channels, you might have observed this. Whenever a news breaks, immediately you will see a spike. If it's a good news, you will see a spike in the price of the stock. If it's a negative news, you will see an immediate fall. Okay? So, its stock price immediately rises if it's a good news. So, investors cannot gain an advantage by acting on this news later, since the information already got factored into the price. Okay, so for example, if the news was that the earnings got doubled over the last year, immediately as the results are announced by the company, the stock will move upwards, and by the time you are able to buy the stock would have risen and you will not be able to make any gain. So that's about the informational efficiency as to the extent, how much of information is captured in the stock market. Different stock markets exhibit different informational efficiencies. Mostly what we see, we're going to be covering that later in the next topic. We see semi-strong form efficiency in the markets, as in all the past and the public information is reflected in the stock price. Okay. Then, lastly, we have pricing efficiency. Yeah. Pricing efficiency, it examines whether market prices accurately reflect all known information about a stock. This ensures that prices provide a true representation of a stock's intrinsic value. Suppose there's news that a pharmaceutical company has received approval for a breakthrough drug. In a pricing efficient market, the company's stock price will increase to reflect the anticipated growth in future weeks. Okay, so how accurately the market is able to reflect all the information in a stock's price, that is what pricing efficiency is, whether the stocks are priced accurately or not. So together, these efficiencies contribute to a well-functioning financial market that drives economic. So all these efficiencies, they are reflected in the financial market of any country. Please go through it once. See if you're getting any doubts. Read through. Any doubts? Okay. So now we will move to efficient market hypothesis, which is based on informational efficiency. I told you very important as to the extent to which the information is reflected in the stock price. So that could be weak form. Okay, it could be weak form. It could be semi-strong form, or it could be strong form efficiency. The informational efficiency can be of three types. Let's understand what they are. So EMF states that stock prices reflect all available information, making it impossible to achieve higher returns than the overall market without taking on excessive risk. Okay? That the information is already factored in the stock price. So if you act on some news or some information, you'll not be able to make any special gain out of it because the market has already factored it into its price. So that's what EMX states. Now it classifies market efficiency into three levels. Number one is weak form efficiency. So in a weak form efficient market, share prices reflect all historical price data. That all past information is reflected. This means technical analysis, which involves studying past price trends, cannot consistently lead to better returns. Those of you who like studying the markets, you will know what technical analysis. Technical analysis is understanding the chart patterns of the stock price movements. So, in a weak form efficient market, see, this is talking about the extent to which the information is captured. Now, the first extent is up to the past information, that is the historical price data. So, in a weak form efficient market, share prices reflect all historical price data. This means technical analysis. What do you mean? Chart pattern analysis. So, it means that chart pattern analysis or technical analysis, which involves studying the past price trends, cannot lead to better returns. Investors can make abnormal gains by using public or private information. So, what does it mean? You analyze, for example, the historical prices of Apple and notice a recurring trend every December. In a weak form, efficient market, knowledge of this trend that, okay, every December the stock price goes up, the knowledge of this will not help you make above average returns because everyone in the market knows that the stock price moves in this manner. So, you'll not be able to make any gain out of purchasing the share and then selling it because the price would have already factored these aspects in it. So, because past price data is already reflected in the current stock price. So, the pattern has already reflected. So, you cannot act on this and make abnormal gains. In a weak form efficient market, you can make abnormal gains, that is above average returns from the market, by making use of some public or private information because the stock price has not factored it into It's in itself the past or the private information. So in a weak form efficient market, only the past information is reflected. Any public or private new information is not reflected in it. So if you get access to it, you can make abnormal gains out of that information. Then you have semi-strong form efficiency. In a semi-strong form efficient market, share prices incorporate all publicly available information. So past information, yes. In addition to it, all publicly available information is also factored in the stock price. So share prices incorporate all publicly available information, including financial statements, news reports, and economic indicators. Neither fundamental, sorry, neither fundamental analysis, that is, you evaluate a company's financial health, nor public news can give you an advantage because the market instantly adjusts prices to the new public information. Immediately, the stock prices move in response to any news. However, you can make abnormal gains by using insider information. Private information is insider information. So that is why you know, right? In India, insider information is banned because you cannot make a gain by having by having an upward advantage in the markets. Everyone should have a fair playing game. That's why insider trading is not allowed because the Indian markets, or basically most of the markets across the globe, they are semi-strong efficient. Public news is factored in the stock price, but any private information or insider information is not. So if you have some private information with you, you can make abnormal gains. Gains which the markets could not have anticipated. So example, Tesla announces record-breaking quarterly earnings. In a semi-strong market, Tesla's stock price will immediately adjust to reflect this news. By the time you try to buy the stock after reading the earnings report, the price will already have risen, leaving no room for profit based on this information. You cannot make a profit based on the information of good results in the quarterly release of information by the company. That is semi-strong form efficiency, which is seen across the globe mostly. And lastly, we have strong form efficiency. It's more of a theoretical concept not seen anywhere in the world. So in a strong form efficient market, share prices reflect all information, including insider information. So even insiders with confidential company data cannot earn abnormal returns means above average returns. So even insiders with confidential company data cannot earn abnormal returns because the market already prices in all the relevant information, including this insider information. So if the insider information is good, the stock would have already risen. If it is bad, the stock price would have already fallen. So the market already prices in all the relevant information. Example, imagine an executive at Microsoft knows about a pending acquisition before it's made public. In a strong form efficient market, he cannot profit from this knowledge. He cannot profit from this knowledge because the stock price already factors in even undisclosed information. This is rarely, this, as I told you, it's a theoretical concept. This is rarely the case in real world markets. Most markets exhibit semi-strong form efficiency rather than strong form. Participants with insider information can make abnormal gains in such markets. Yeah, that's about the efficient market hypothesis. It develops on informational efficiency. Please take a look at it. read through. Any doubt, let me know. All of you, please read when I give you some time. At least have a quick glimpse at the topic so that anything which you're not able to understand, you can ask me right away. Okay, so there are no doubts. We'll move on. So there is this paradox of efficient markets. Very interesting concept, listen to me. So for markets to remain efficient, investors must actively analyze information. Basically, investors should be active for markets to remain efficient. Now, when will investors remain active? When they believe that there is some scope for them to make gains. So, for markets to remain efficient, investors must actively analyze information to identify and exploit mispriced stocks. This research and trading activity helps align stock prices with their true value, thereby ensuring market efficiency. So, investors are always on the lookout for some mispriced stocks, okay, so that they can make gain out of it. However, if the market becomes perfectly efficient, where all stocks are always correctly priced, there would be no mispriced stocks left to exploit. Consequently, investors would stop analyzing and trading actively, causing the markets to become inefficient again. So, this paradox, see, you want the markets to be inefficient, right? You want the markets to be inefficient. So, this paradox suggests that a market can only remain efficient if investors believe it is inefficient. Okay. So, that belief is what drives the market participation. That there is some unexplored stock, some unexploited stock, which the investors, okay, you might have heard that the stock is underpriced, overpriced, and then the investors start buying or selling them. So, this inefficiency which the investors believe is there in the market is what drives their participation. So the paradox emphasizes the importance of active participation by investors in maintaining market efficiency. Without this participation, markets cannot remain efficient. If the investors are not active in the markets will not be efficient. Okay, so that's the paradox of efficient markets. Simple concept. Now, the next topic that we have is behavioral finance. The decision of the finance managers are a lot of times guided by their personal emotions. And this is true. If you are already working, you might have experienced this. That a lot of times the decisions that you take, now specifically in the finance field, I'm talking, it could be guided by personal emotions. However, this can lead to irrational behavior, basically, suboptimal behavior. So, the different scenarios where this may arise include number one, avoiding to invest in sin stocks for ethical considerations. A lot of times, finance managers they do not want to invest in sin stocks like tobacco, liquor company stocks. Then, holding on to declining stock, refusing to acknowledge the poor investment decision made in the past. So, a lot of times we just keep on holding to a declining stock. We acknowledge, we fail to acknowledge that a mistake has been done. And in case of takeover, quoting inflated bid price due to the desire to win the competition. A lot of times you quote higher and higher prices just because you want to win the bid, but then you may not be able to justify that bid value for the worth of company that you have acquired. So these are some examples of the scenarios where personal emotions creep in. Following are the key behaviors which explain why investors deviate from fundamentals. Now, investors or financial managers, you can say, why do they deviate from their core fundamental values? These are the key behaviors which explain it. Number one is anchoring. Investors rely heavily on specific reference points called anchors, such as historical price levels, PE multiples. And what is PE multiple? Price to earning ratio multiple. That companies of this industry they trade at, let's say, 10 times of the earnings. So that's PE multiple or other past metrics when valuing a stock. They fail to adjust sufficiently for new information. Example, an investor assumes a stock is fairly priced at a PE ratio of 15 because that's its historical average. Even if market conditions or the company's earnings growth justify a different PE, the investor sticks to this anchor and it may undervalue or overvalue the stock. Just because this has happened in the past, they believe that it will continue. It's like they do not want to see the reality. They are anchoring their decision on a specific reference point. Okay, so that's called anchoring. Anchoring is relying heavily on specific reference points. You are anchoring your decision on something which may not be the correct point. Then, gambler's fallacy. See, we are talking about the different behaviors observed in the markets, okay? The first one was anchoring that you rely heavily on some specific reference points. Gambler's policy is investors wrongly believe that recent price trends will reverse. This I'm sure a lot of you might have also seen or observed. If you're not active in the markets, not start reading or watching business news, you will really enjoy my classes much more. There are a lot of topics which you'll be able to correlate from the real world scenario. So you must have seen this. When the markets are rising in the upward trend, then there will come a air of thoughts in the mind of investors that the markets have risen for so long, there will come a correction. There will come a correction. Now, for example, the gold and silver prices currently, it's going upwards in a one-way stride, and investors are strongly feeling, that this is too high a price. There will be correction soon. So, what it is? Gamblers' policy. Investors wrongly believe that recent price trends will reverse simply because they have persisted for a while. Even when there is no rational basis for such an expectation, it is possible that the gold and silver prices may still rise from here. For example, a stock has risen steadily for 6 months. An investor assumes it is due for correction, even though the company's fundamentals, there is strong revenue growth, profitability, everything is there. Support continued appreciation. Acting on this belief, they sell the stock too early, missing out on further gains. Okay, so that's the gambler's policy. Then we have positive feedback and extrapolative expectations. Investors follow trends, assuming that past price movements will continue indefinitely. This behavior often leads to market bubbles and crashes. Now, here, you believe that what is going on will continue forever. In gamblers' policy, the expectation, the investors, they feel that the trends will reverse. Here, the trend will continue. So during the dot-com bubble of the late 1990s, investors piled into tech stocks as prices rose, assuming the upward trend would continue. This herd behavior caused prices to deviate significantly from their fundamental values, eventually leading to a market crash because it created a bubble. Stock prices were rising and rising and rising without any full stop. And then ultimately, the bubble crashed. Next behavior observed in the markets, noise trading. Again, very common and very abused behavior, I would say. So decisions are made based on irrelevant or random factors, noise in the market, rather than fundamental analysis. Noise traders often follow rumors, short-term market movements, or emotional reactions. This is what plays on the minds of retail investors, I would say. A lot of times you would observe that a news is floated around about a company, and then these retail investors who do not have very strong knowledge about the stocks, they start acting on that noise. That is noise trading. So decisions are made based on irrelevant news, which is just floating in the market, and that is deliberately floated. You will see YouTube videos getting created, news channels flowing that information. A lot of times it happens that there is this news going on. So decisions are made based on irrelevant or random factors rather than fundamental analysis. Noise traders often follow rumors, short-term market movements, or emotional reactions. Example, an investor hears a rumor on social media about a potential merger and buys the stock despite no confirmation or credible evidence. Just because there's this news going on, some noise going on, they act on it. This decision is not based on the company's intrinsic value or financials, but rather on noise. Next, we have entrapment. Investors double down on a failing strategy or continue pouring money into a losing investment to avoid acknowledging a loss or mistake. A lot of times you would have seen, I'm also guilty of this. I've done it on a lot of occasions. So you buy a stock, okay, and then its price falls. You feel that, okay, let's average it down. You buy more of it. You don't realize, but you're getting entrapped. So an investor buys a stock at $100 and it drops to $50 due to declining business prospects. Instead of selling, they invest more than $50, hoping to average down their costs and recover losses even though the company's outlook has worsened. Okay, so that's entrapment. These are some behaviors which you would see among investors or financial managers. Please take a look at it, read through. Anyone having any doubt, let me know. All of you go through it. Done now. So these are the different behaviors observed. Now, question which arises is why investor perceptions and emotions distort decision making. Why does it happen? First reason, overconfidence. Investors overestimate their abilities or knowledge, leading to excessive trading or risk taking. They overestimate their abilities. That's what overconfidence is. Example, a novice trade investor believes they can constantly outperform the market due to few successful trades. As a result, they trade frequently, ignoring transaction costs and risks, which often erode their returns. So that is overconfidence. Then representativeness. Judgments are based on stereotypes or patterns, often ignoring fundamental factors. Okay, just because there is a pattern to it, it's a stereotype decision. They often ignore the fundamental factors, fundamental reason. See, there is a fundamental of a company which is reflected in its revenue, its profitability, its cash flows, its statement of, assets. So instead of basing opinion on the fundamental values, investors look at the patterns. Okay, this has happened in the past, it will recur now. There's a stereotype to it. Example, after a tech company stock prices rise for several months, investors assume it will continue rising indefinitely. So there's a stereotyping, ignoring warning signs like declining earnings or increased competition. Okay. Then momentum effects. Investors follow trends leading to prolonged market booms or busts. So during a bull market, rising stock prices create optimism, encouraging more investors to buy in, further inflating prices and delaying the corrections. Okay. Then conservatism, resistance to adjusting opinions despite new evidence. You want to believe in something even though you have evidence of the opposite because you've decided that you want to believe in it. So, example, an investor continues to believe in a company's future growth potential even after multiple reports show declining revenues and market share. You don't want to open your eyes to some new information because you made a decision and you want to just believe in it. You don't want to have counter to it. So that's conservatism. You resist adjusting opinions. Then narrow framing, focusing only on specific assets of an investment, often ignoring the broader picture. For example, an investor avoids investing in stocks altogether due to short term market volatility, overlooking the long term historical growth of equities. Okay, so that's narrow framing. You're having a very narrow outlook. Then ambiguity aversion. What is it? Fear of uncertain or unfamiliar investments leading to missed opportunities. A lot of times we will say that investors they restrict themselves to only few stocks. Okay? So an investor avoids investing in international stocks due to unfamiliarity because I'm not clear with it. So I'm unfamiliar with it, so I don't want to explore it. With foreign markets, even though diversification could reduce portfolio risk. You know this if you're aware, let me know. Are you aware of this Parak fund, mutual fund? Anyone? Gained a lot of popularity. Anyone into investing? Heard about PPFAS? No one. What do you do with your earnings? Don't invest. No one invests here. Oh, okay. All right. So, it's a fund which gained a lot of popularity. It's a mutual fund and delivered very good returns. And that was more because it was investing heavily in the US stocks. And now after a lot of restrictions came in about Indian companies investing in or Indian funds investing in foreign companies, the returns which it was giving earlier, it has started to disappear. Right? So, what does it show? That sometimes, see, it is an opportunity which Parik took at that time. So, it gave them an opportunity. However, if you do not make use of such opportunities, then that is gone forever. Okay, it's a missed opportunity. So, an investor avoids investing in international stocks due to unfamiliarity with foreign markets, even though diversification could reduce portfolio risk. Okay, so again, this is a behavior observed that investors don't want to put their money in areas which could be unfamiliar to them. Okay. Losses happening, was it because you were actively trading in it? I'm talking about investment. See, difference between trading and investment. Always consider investing for the long term. Find out some good companies. How do you find out good companies? That's through fundamental analysis of the companies and stay invested in the long term. Earlier, when I also started off my investment journey, it was through stocks. Now, gradually, because of the paucity of time, I don't get a lot of time to track my investments. I've moved mostly to mutual funds. I keep track of the mutual funds which I invest, like how much of a return that they are giving, XIRR, and I keep my investments like that. So, I've done trading also in the past. Good trades, bad trades happen. I'm talking about investment here. Okay, and if you're not investing, please do start it. Or it could be a small amount, big amount, but you should definitely consider investing. All right. And of course, if you start investing also now, you will start finding the topic AFM also a lot more interesting because then you will be actively engaged in the market. Just consider start making investments if you're already not, and do some analysis. Again, I can't be teaching you that here in this paper, but you should start. Okay, so first we were talking about ambiguity aversion. Now we move to regret aversion. So regret aversion is fear of making wrong decision. See, a lot of times, and this is not just for financial decision. A lot of times we don't take a decision because we fear what if you're wrong. We don't take risks. Okay. So fear of making a wrong decision leads to avoiding potential benefits. See, risk gives you rewards. If you don't take risk, you don't get rewards. So an investor keeps all savings in cash, avoiding the stock market altogether. You're like, okay, I don't want to risk anything. I'll keep my cash in my drawer. So due to the fear of losing money, I don't want to lose money, I'll not invest. You can lose out on potential higher returns as well. Okay? So that is regret aversion. Then confirmation bias. Seeking information that supports existing beliefs and ignoring contradictory evidence. Investors believe that the stock will rise, and then they start finding news articles, everything which supports their claim that the stock price will rise. So an investor believes the stock will rise and only reads articles supporting that view, ignoring reports highlighting potential risks. Okay? So trying to get a confirmation. Okay, that what I am doing is right. You're looking for confirmation on that. In any contradictory view, you are ignoring it. So that's called a behavior called confirmation bias. Then availability bias. Overemphasis on recent or prominent events influences decisions disproportionately. Example, after hearing about a high profile bankruptcy in the energy sector, an investor sells all energy stocks. One of the companies filed for bankruptcy. All the stocks which the company had in the energy sector, it sells it. despite strong fundamentals in other companies in the industry. So, because there was decent news of a company failing in the sector, the investor decided to sell all of its investments in that sector. So that's see, these are all behaviors which lead to irrational decision making in the markets. We're talking about that. So in this way, they made a wrong decision. Then miscalculation of probabilities. Assigning incorrect probabilities to outcomes. Example, an investor avoids purchasing insurance for rare catastrophic events, but spends heavily on lottery tickets, assuming a high likelihood of winning. So it's all about assigning probabilities. They feel that, okay, their chances of winning the lottery are higher and the chances of a catastrophic loss is less. So they buy lottery tickets rather than buying insurance. So that's miscalculation of probabilities. So we zoom out. We'll discuss the factors one by one again. So what have we covered? We are talking about why do investors make incorrect decisions. Number one, overconfidence, over faith in their own decisions. Representativeness. They are following a stereotype or a pattern. Then momentum effect. They feel that what is going on will go on. Conservatism. You don't want to adjust to new opinion. You want to believe what is you have decided is correct. Narrow framing. You look at the smaller picture only, not at the bigger picture. Then ambiguity aversion. You don't want to try unfamiliar grounds. That leads to incorrect decision making. Then regret aversion. You don't want to regret something, so you don't take risk altogether. Confirmation bias. You keep on seeking evidence which supports your views. That's confirmation bias. Availability bias. Whatever news is available in the market, you act on the basis of that. Then miscalculation of probabilities. You do not assign the probabilities correctly of the events which are likely to occur. These are the behavior. Please read through it once. Let me know when you want me to scroll down. Read through with the examples. If you have any doubt in any point, let me know. Done? I'll just scroll down a little, have a look here. Please go through it. Okay. So if there are no doubts, then let's take a break here. We'll break for about 15 to 20 minutes, and then post the break, we will continue our discussion. So this was more of a theoretical introduction to the chapter of security valuation. And in the next half, we are going to be starting off with the dividend-based valuation. So interesting things lined up. Fresh yourself. We'll catch up in about 20 minutes. Okay? Hello everyone, welcome back from the break. Let's continue our discussion. So we will now look at some concepts relating to dividend. You know there are terms called cum dividend and ex dividend. Anyone aware about it? What is cum dividend? See, every time a share is declaring dividend, okay, the share price rises. Okay. So for example, the price is in the market $100 for a share. Dividend of $2 is declared in the meeting of the shareholders, okay, that this is decided. $2, immediately the price would rise, and this would stay in the price of the share until the cutoff date or until the record date. Okay, correct. So until the dividend is paid out, the share is trading at cum dividend price. Once the dividend is paid, the price of the stock comes down, okay, and the price is known as ex-dividend price. I'll repeat myself. What is it? Cum dividend. This is the share price before the dividend payment is deducted. Investors who buy shares, now very important. Ma'am, why is it that the share price increases? Because investors who buy shares during this period are entitled to receive the upcoming dividend. So, if the share was trading at $100, dividend of 2 was declared, the share price will start trading at 102. So, if an investor wants to purchase the stock now, they will have to pay 102, and they will later get back 2 as dividend. So their net cost remains 100, which is the same as any other investor who was holding the stock from before. Okay. And ex-dividend is what? This is the share price after the dividend payment has been deducted. Investors who buy shares during this period are not entitled to the upcoming dividend payment. So once the dividend cutoff date, record date is gone, this will again start trading at $100. So this is cum dividend. This is ex dividend. Okay. So if you purchase the stock at this price, you will not get dividend because the record date is gone. Let's take a look at it and understand it better with an example. A company declares a dividend of $2 per share. The cum dividend share price is $50. So once the dividend is paid to the shareholders holding the shares on the record date, that is the cutoff date, the share price drops by the amount of dividend, and the ex-dividend share price would become 50 minus 2, $48 per share. Okay, so that's the concept of cum dividend, ex-dividend. Again, it's a very knowledge level topic. I'm assuming you will, of course, be aware of these topics, cum dividend and ex-dividend. When the share price is including the price of dividend, it's called cum dividend. Once the record date is over, the stock starts trading at ex-dividend price. And why is it so? Because if an investor buys the stock before the record date, they will be eligible to get the dividends. So the stock prices rise before that, so that all investors are at parity. Similarly, we have a concept called cum rights and ex rights shares. Okay, just like we saw cum dividend and ex dividend, we have a concept called cum right and ex right share price. What are rights shares? What are right shares? When you are an when you're a shareholder of a company and the company comes out with a further issuance of shares, as the existing shareholders of the company, you are entitled to be offered those new shares first. That's called rights shares. Okay. So, rights share is an additional share offered by a company to its existing shareholders, giving them the opportunity to buy more shares at a discounted price. So, the new shares are sorry. So the new shares are offered to the existing shareholders at a discounted price. So what is cum rights? This is the share price before the rights issue. Investors holding shares are entitled to subscribe to additional shares at a discounted price during a rights issue. So just like we have a cutoff date, a record date for dividend, we have a cutoff date, record date for rights shares also. So by the time you have the option to get the right shares, you will have to pay extra for it. So that's called a cum rights price. This is the share price right before the rights issue. And once the record date is gone, so this is the share price after the rights issue. The price usually adjusts downwards to reflect the dilution caused by the issuance of additional shares. Okay. So that is cum right and ex right. Now, let's take a look at this. How do you find out the X rights price? That's an interesting calculation. See, these are all brought forward knowledge topics. Still, if you have any doubt, please don't hesitate to ask. You can ask me. Example, a company announces a 1-for-4 rights issue. What does it mean? That for every 4 shares an investor holds, he will be eligible to buy 1 right share. So company announces a 1-for-4 rights issue allowing shareholders to buy 1 share for every 4 shares they hold at $40, while the cum rights price is $50. So calculate the X rights price. So that's called theoretical X rights price, also TERP, or simply X rights price. So how do you calculate it? Have a look here. Again, it's a broad forward knowledge. See, what happens is normally these things they will come casually in any question, but I'm discussing this so that it doesn't come as a surprise to you. So original number of shares, how many shares you need to hold? You need to hold 4 shares from before. At what price? What is the price right now? 50. And for every 4 share, you're eligible for 1 right share, and it is at a discounted price of $40. Correct? So what is the weightage of original shares? I can say 80%, 4 by 5. And right share is 1 by 5, 20%. So what is the weighted cost? That is the theoretical exit price. Basically, once the record date is over, the stock would start trading at $48. 15 to 80% plus 40 into 20%. That is $48. Please take a look at this concept and the calculation. See if you're getting any doubt. How to compute X rights price? See, X dividend share price is very simple. You just need to deduct the amount of dividend from the cum dividend price. To get the ex-dividend price. How do you compute the ex-rights price? Have a look here. Please check. Any doubt? Anyone? Let me know. Go through the calculation. Done. Simple calculation. You need to find out the weighted cost. Now, why has the price come down from 50 to 48? Because you gave shares at a discounted price of $40. For every 4 shares a person held, you gave them 1 share at $40. That is why the ex-rights price is less than the cum rights. Similarly, we have cum bonus and ex bonus share price concept. What is a bonus share? See, rights shares are discounted shares which are given to the existing shareholders. Bonus shares are free shares which are given to the existing shareholders in proportion to their current shareholding. So again, just like we had a rights issue ratio, no? 1:4. Here also you'll have a bonus share ratio. So bonus shares are distributed from the company's accumulated profits and do not involve any cash transaction from the shareholders. And bonus shares are also known as scrip dividend. Ma'am, why so? See, normally you have cash dividend. What is cash dividend? It is a distribution from the reserves of the company of cash. Here also it's a distribution from the reserves of the company, but in the form of scrip. Scrip is what? Any security, share. So that's why it's called scrip dividend. So cum bonus, ex bonus. So this is the share price before the bonus shares are issued. Investors holding shares during this period are entitled to receive the bonus shares. And of course, ex bonus after the record date, the price is adjusted downward to reflect the increased number of shares. Example, a company announces a 1-for-2 bonus issue. Calculate X bonus price when the cum bonus price is $90. So 1:2 means what? For every 2 shares held, the investor would get 1 bonus share. So that is a weight of 67%. Original share, bonus share will be 33%. Its cost is 90. And what is the cost of the bonus share? 0. It's free share. The X bonus price would be $60. You know, when it's a 1-for-1 bonus share, let's say I change this to 1, the price becomes exactly half because the number of shares doubled without any value increase. So this is how you compute the X bonus price. Please take a look at these basic simple calculations. Any doubt, let me know. All good so far? Anyone doubt? Please participate in the class. If you don't participate, I will assume everything is fine. If you have any doubt, please let me know. If it's fine, then also let me know. Then it gives me confirmation. Don't make it a one-way class. It will become boring for me also, you also. Please keep participating and make it an active class. All right. Moving on. Now we get into the topic. So these were all brought forward knowledge. So dividend valuation model. Anyone who is coming from like who has studied FM before, like not coming from the exemptions route. Anyone who has done FM? Vartika, yes. You will be finding this topic super easy because this is a topic which there at the FM level and then it just gets a little elaborated here. The level of computation uh, could become a little complex, but the basics are exactly as what we have done in the FM paper. So we have the dividend valuation model, also called the dividend discount model. Now we are moving to the main part of the chapter, which is security valuation. And the first security that we are valuing here is equity shares, and that is through the dividend valuation model. Okay. So the DVM implies that the market value of a share is equals to the present value of the future expected cash flows, that is the dividend from the shares discounted at cost of equity. Okay. What does it say? That the value, in simple words, that the value of a share is the present value of the future dividends discounted at cost of equity. Okay. Now, we're going to be covering this in three different categories. One is no growth. That's the company gives a constant dividend. There is no growth in the dividends. Then second is constant growth TDM or DVM. Okay. So first is no growth, same dividend per year. Case 2 is constant growth. The dividends are growing every year. And the third scenario is multiple growth TDM. Okay. So very interesting. So case 1, no growth TDM. Now imagine a firm which has a 100% payout ratio. That is, whatever it is earning, it is distributing as dividends. Nothing about it. A company makes $100. Okay. Net after all the expenses has been paid off, all these done. It has got $100. Now, with this $100, it has two options. One is that it retains something, which you might have heard as retained earnings, or it may pay as dividends. That these are the two options only. Either it will retain the money in the business to grow the business further, or it will pay as dividends. Now, if the company does not retain anything, do you think there will be growth in the company? Whatever it is earning out now, it will continue to earn that only because it is not reinvesting anything on its growth. So, in a no growth DDM, the assumption is there is a 100% payout. Whatever the company earns, basically EPS is equals to DPS. Okay. Since there is no retention of profits, that is no plowing back of profits, its growth rate is 0. If you're not keeping anything in the business, from where will the growth come? You're distributing all the money to the shareholders. So that is a case of no growth DDM. In that case, you will have a perpetuity of the dividends that you're paying to the investors. Every year you will earn the same. And why will we earn the same? Because we're not keeping anything in the business. So there will be no growth. So in that case, we have a perpetuity. Then what is a perpetuity? Same cash flow every year. Same cash flow every year. That's called a perpetuity. Forever. So what is the formula of a perpetuity? Present value of a perpetuity? So it's like same cash flow every year forever. So as per the statisticians, the formula which has been derived for any perpetuity, not necessarily for a dividend perpetuity, for any perpetuity, the formula is cash flow divided by the discount rate. You get the value or the present value of perpetuity. Okay, that's the formula. Present value of perpetuity is equals to the constant cash flow, the constant cash flow by discount rate. Okay. So in this case, what would be the cash flow dividend per share? By cost of equity. Cost of equity, you can denote it as KE also as RE. Or both of them are the same. So P0 is equals to DPS by cost of equity. So P0 is what? Price of the share. See, please understand what is the dividend valuation model about? Dividend valuation model is about that the share price is equals to the present value of the future expected cash flows. It is the present value of the future expected cash flows. So P0 is what? Market price. DPS is what? The constant dividend per share. Cost of equity is the return which is required by the shareholders. So simple formula. That's how you value an equity share under a dividend valuation model in a no growth scenario. Example, have a look here. Annual dividend $5. Required rate of return is 10%. What is the share price? Quickly, fastest fingers first. Quickly tell me what is the share price of the company? Taking so much time, simple. It's an FM level topic question. Be fast. Okay, Praksha has responded. Perfect. Ritika, Vicky. Sairishi Jaya, may I know your name, please? I think two names are coming here. Jaya Bajaj. All right. So good. All if you're right, the answer is $50. The share price would be 5 by 10%. Now, case 2, constant growth. Now, imagine a firm which is expected to pay a dividend of D1 next year. Be very careful. It's a simple topic, but very confusing for some students. And highlighting it for you. Expected to pay dividend of D1 next year. See, in finance, I'm telling you generally, in finance, year plays a very important role. 0, 1, 2, 3, 5. Okay. What does it mean? What do you mean by year 0? What do you mean by year 0? Absolutely right. Manoj, give me the perfect answer. Just today. Year 0 means today, immediately. Year 1 is end of the current year. So today is 13th September 2025. So 13th September 2025 would be year 0. It would be denoted as year 0 in finance. Year 1 means end of this year. That would be 12th September 26. I'll take easy numbers so that you relate better to it. Are you able to understand? So this is 1st January 25, that is today. End of the year, that becomes year 1. Then 31st December 26 would be year 2. So it is assumed that the cash flows arise at the end of the year in finance. Am I clear? Very basic thing. So always remember, year 0 means today and year 1 means at the end of year 1. Year 2 means at the end of year 2. Like that. Okay? So on and so forth. So coming back, what does it say? Imagine a firm which is expected to pay dividend of D1 next year. D1 meaning what? End of the current year. Next year meaning after 1 year. So after 1 year meaning what? End of the current year. So D1 is expected to be paid at the end of year 1. It will grow at a constant rate G forever. If the required return is RE, the value of the share will be calculated as follows. So basically, the dividend is expected to grow by a growth rate of G. The formula which has been derived by the statisticians is P0 is D1, that is the expected dividend in 1 year's time, divided by RE minus G. Just try to relate it with this formula here. Observe this. this with this. P0 in a no growth scenario was DPS by KE. Here it is D1 by RE or KE, whatever you want to use. You can use it interchangeably. Don't worry about that. D1 by KE minus G. And why is G in the negative? Ideally, growth is something which should be added. Tell me something. When what would be higher? The price of a share of a company which grows its dividend or which does not grow its dividend? What would be higher? Just generally asking. In your view, which company's share would be higher? Share price would be higher. The company which pays dividend, same dividend every year, or a company which gives a growth in dividends every year? Tell me. Company with a growing dividend or constant dividend, which would be higher? The one with growth in dividends. When you're giving growing dividend, it means what your company is growing, then only you are able to give the growing dividends now. You plot back some profits, you reinvested it in some business, you grew your business, then only you are able to give growing dividends to your company's shareholders. So imagine a firm which is expected to pay a dividend of D1 at the end of year one. It will grow at a constant rate G forever. So all of you said that company which gives growing dividends will have a better value among the shareholders. Of course, see, think of it from the point of view of the shareholders also. Now, who will you value more? Consider yourself as a shareholder. Where will you believe there is more value? Company which is giving you higher dividends, higher cash flows in the future. Now, when I do minus G in the denominator, the resultant value will be higher or lower? Higher. B1 by KE minus G. When I'm reducing the denominator, the resultant value will be higher, of course. Basic maths. So don't get confused as to why G is in minus and not in plus. So the formula is D1 by KE minus G, where D0 is equals to the current market price of the share. D1 is dividend in year one, where, and this D1 can be computed as where D1 is equals to D0 into 1 plus G. And what is this 1 plus G? Let me tell you a simple example, and I'm again telling you a very important concept of growth along with it. And in general, the concept of growth. So let's say your current dividend or D0 is 100 and G is 5%. What is D1? Compute and tell me D1. Or if you're telling me 105, how do you compute it? Those of you have studied from me before already, I've told you this. So not for you, those of you who are coming for the first time to my classes. Now, one way is you first calculate 100 into 5%, that is the growth, 5. And then you add this 100 to 5. And then say it is okay, D1 will be 105. right? 100 into 5% and then plus 100. Can I say what I've done is basically 100 plus 100 into 5%? Can I simply write it as 100, 1 plus 5%? Okay, what is that? D0, 1 plus G. It's nothing to memorize, simple maths formula it is. So, whenever you are asked to use growth, use it with factors. See this 1 plus 5% now? It's called growth factor. It's called growth factor. So instead of going this way, long way, that you first compute 100 into 5%, then you add 100 to it, what you should do is 100 into 1 plus 5%. 105. I know it's a very simple basic calculation, but then sometimes students later ask me also, ma'am, how did you arrive at this? And why do you multiply with 1 plus? So I've told you the derivation right in the first class. So 100 plus 100 into 5%, instead of doing this, what I'm doing is 100 into 1 plus 5%. Am I clear, everyone? So this is D1. How do you compute it? D0 into 1 plus G. So where D1 is equals to D0 into 1 plus G. Now RE is return required by the shareholders, or you can say cost of equity. Now, G, growth rate. Very, very important. So there are two ways in which you can compute the growth rate. One way is that either they will give it to you, okay? But sometimes you might have to calculate the growth rate. So the first approach is G is equals to B into R. G is equals to B into R. It's called Gordon's growth approximation, where B is equals to retention ratio and R is equals to return on equity. That is PAT by equity. Ma'am, why is this formula like this? Why B into R? Now think about it. What did I tell you just some time back? That when a company makes $100, it has two options. One is it retains in the business and it grows the business further, or it distributes as dividend. See, when a company distributes the money as dividend, it cannot grow its business. It doesn't have the money to reinvest in the business. So always remember, the growth in a business comes from reinvestment of profits only. Okay. So whatever you retain, that gives rise to growth. So where B is equals to retention ratio. So what is retention ratio? So you earn an EPS of $100. Okay, you earn an EPS of $100. So DPS is, let's say, 40. So your dividend payout ratio would be 40%. Okay. And your retention ratio So out of 100, if you have paid dividend of 40, how much have you retained? 60. So retention ratio would be either you do 100 minus 40, 60, 60 by 100, or you can simply do 1 minus 40%. Here, everyone. So retention ratio is basically how much percentage of the profits you have retained in the business. Okay. So that is retention ratio. And R is return on equity. So out of the 60% profits that you retained in the business, you earn a profit at the rate of, let's say, return on equity. So let's say you earn a return of 10% on the investment that you do in equity. Okay. So it is said that the growth would be 60 into 10%. 6% growth is what the company would get as growth. So whatever you are retaining, you will earn profits on that, and that will become your growth in the future. This is the meaning of Gordon's growth approximation formula, G equals to B into R. Why B into R? Whatever you retain in the business, you grow on that only. So retention ratio into return on equity. Okay. Am I clear? G equals to B into R. Remember this formula. R is retention ratio. Sorry, B is retention ratio. R is return on equity. How do you compute return on equity? PAT by equity. And second approach is compounded average growth rates. Compounded average growth rates. Here you compute G as dn by d0 raised to the power of 1 by n minus 1. Ma'am, what just happened? Such a complicated formula, I have to memorize it. If you understand it logically, nothing to memorize. I'll tell you how. Please pay attention here. Till here, all of you are with me. Anyone having any doubts so far? Any doubts, anyone? All right, no doubt. So now you look at this. Compounded average growth rate, again, a very important calculation. One second. Now tell me, what is the growth in dividend in year two? What is the growth in dividend in year two? Quickly, I just taught you the formula of growth sometime back. What is the growth in year two? And if you're telling me 8%. How did you compute it? See, look at this. One way is you first do 108 minus 108 and then you do 8 by 100. That is 8%. That is one way to do it. The smarter way and the way which you are going to be following from today onwards, if you have followed it, well and good. If you have not, so can I say this is nothing but 108 by 100 minus 1, 8%. Look at this. Current value by previous value minus 1. Okay? Now, how did you get that? See, what I did over here is 108 minus 100 divided by 100. This is what I did now, right? First I calculated 108 minus 100 and then I did by 100. So instead of that, so I do it like that as 108 by 100 minus 1. Okay? So going forward, this is the formula which we will adopt. Am I clear, everyone? Can I do 108 by 100 minus 1? Please take a look. Right? So that is how you will compute growth in dividend rightly calculated as 8%. Now tell me, what is the growth in dividend in year 3? Quickly. Tell me up to one decimal place. Let's see. So do the same formula. 112 by 108 minus 1. So rightly calculated 3.7%. Okay. Now, Average growth. Okay, let's do one more. Growth in dividend in year 4. Similarly, I can do it like this. 125. So you can see that different growths have happened. Okay. Can I say simple average growth in dividend is 7 point. That's a simple average growth in dividend. 7.8%. I want to know compounded average growth in dividend. How do I find that out? The simple average is 7.8% growth. So compounded averages. What were we doing till now? 125. So basically, 100 has become 125. Acha, tell me one more thing. How many times has growth happened here? How many times has growth happened here in the information given? 3 times, right? So can I say 100 has become 125 in 3 years? So far what I was doing is 125 by 100 minus 1. This is 25% growth, but this is not correct. This is 25% growth over 3 years. So I insert just one element. And what is that? Raise it. See, everything is same. I've not changed anything. 125 by 100. I just insert one element. Raise it. So you have to press Shift 6 on your keyboard. So raise it to the power of 1 by 3. Remember why 3? Because the growth has happened 3 times. So raise to the power of 1 by 3. Minus 1 is same. And the average growth, compounded average growth rate is 7.7%. Please take a look at the formula. Let me know if it is clear. Any doubt, let me know. This is the compounded average growth. Please take a look. See, I could have very simply just told you that this is the formula, memorize it, but I wanted to visualize how this formula has arrived. Clear, everyone? This is the compounded average growth rate. Okay. Now I'll take you back. This is what it is. dn by d0 raised to the power of 1 by n minus 1. That's the second approach to calculate G. Okay, let's take a look at some simple examples here. RS company has just paid a dividend per share of $0.3. This was 60% of EPS. Estimated return on equity is 20%. Calculate estimated rate of dividend growth. And give it 2 minutes to solve. Please try this. All of you, please try and send in your answers. So, 8%? No, no, I was just giving you time to solve. Class is not over. Class is still 12. So, dividend rate is what? 60%? That's the dividend payout ratio. So, retention ratio will be what? 1 minus 60%, 40%. Okay. Return on equity is 20%. Given in the question, so growth rate will be what? 40 into 20, 8%. Is it clear, everyone? The answer is 8%. Simple question. Again, let's try this one. AB company has just paid a dividend per share of $0.4. Just paid. This has grown from $0.3 4 years ago. Calculate estimated rate of dividend growth. Please try this quickly. All of you, try and send in your answers. I'm here. Okay, I see. Let's check. So, what is the formula of G? D current dividend is $0.4. Earlier dividend. Point through number of years of growth for growth. G is equals to what? 0.4 by 0.3 raised to power 1 by 4 minus 1. That is 7.5%. How come you're getting 10%? You're applying 3 years. No. This has grown from 0.34 years ago. So exactly they've mentioned here that the growth is of 4 years. You don't have to do n minus 1. See, this has grown from $0.3 4 years ago. So the growth has happened over 4 years. That doesn't mean the growth is happening over 3 years only. Okay, is it clear? Let's take a look at this now. Simple example, example 3. A company paid a dividend of $2 5 years ago. This year's dividend is $3. The required rate of return is 10%. Calculate the current stock price using the constant growth dividend valuation model. Now, I'll just show you the formula. We got so engrossed in the computation of growth, we might have forgotten the formula of P0. What is the formula? Simple. P0 is equals to D1 by KE minus G. What is it? D1 by KE minus G. Now, please try this example 3 on your screen here. That's it. Yeah. Try example 3. All of you should send in your answers in the chat. All right, I see some of you have tried. Manoj and Laksha. Others also quickly send in your answer. Time is up. You'll have to first calculate G using CAGR approach and then simply apply the formula. D0 is equals to D1 by RE minus G. But yes, be careful. You need to use D1. And how do you compute D1? D0 into 1 plus G. I'll wait for a minute, everyone. Please complete it. See, have a look here. So first of all, as I told you, compute G using the CAGR approach. So that is going to be 3 by 2 raised to the power of 1 by 5 minus 1. Okay, that is G. So D0 is what? 3. So D1 would be 3 into 1 plus 8.45%. Okay. And everyone, please solve in Excel only and continue to link and solve. D1 is 3.25. Cost of equity is 10% for the required return. So P0 is equals to D1, that is 3.25 by RE minus G. The answer is 209.5. Manoj, where did you go wrong? Others, is it clear? Those who could not attend? Okay, D0. Common mistake. So always find out D1 and then do further calculation. All right, let's take a look at one more example. Simple, sweet. A company recently paid a dividend of $4. The company retains 40% of its earnings. Retention ratio is 40% basically. Return on equity 15%, required rate of return 12%. Calculate the current stock price using the constant growth DVM, dividend valuation model. Please try quickly, should take you about 2 minutes. Example 4 on your screen. All right. Let's see. So detention ratio is 40%, correct? So G is what? 15% into 40%, that is 6%. So D0 is 4. Currently, it has just paid a dividend. You want D1. That is the dividend at the end of the current year. That would be 4 into 1 plus 6%. That is 4.24. And 4.24, that is D1 divided by RE. RE is what? 12% minus 6%. So the answer is 70.67. How come so many different varieties of answers are coming? What went wrong? Please check. Anything you want me to explain again, you're not understanding, please let me know. If it's a silly mistake, still let me know where you're going wrong. No relevance of required rate of return. Oh, we used it here. 12%. Required rate of return is to be used in RE or KE. Return on equity. Now, please understand the difference between the two. Return on equity is your PAT by equity. It's an accounting measure. This is an accounting measure. This is the required rate of return of the equity shareholders. Equity shareholders want 12% return on their investments. So that is, this is a financial measure. Am I clear? So both of them got used. Return on equity got used here. See, 15% got used here. And the required rate of return, RE, was used in here. Am I clear? Return on equity and required rate of return are two different concepts. Okay. Manoj, clear now? Okay, Vartika took D1 incorrectly. Common mistake is not to calculate D1. Please do not use D0. You will have to calculate D1. And D1 calculation is very simple. D0 into 1 plus G. 4 into 1 plus 6%, and then use D1 for the further calculations. D0 is not to be used. All right, perfect. Then let's move ahead. So what have we done? We have done no growth and constant growth. Now the third category is multiple growth DDM. What is it? Multiple growth DDM. So in this, we divide the calculation into two parts. We divide the calculation into two parts. First is explicit forecast period. Other is horizon period. Okay. First is explicit forecast period. Second is horizon period. So in explicit forecast period, what will be given is different growth rates are forecasted for different years. Different growth rates are forecasted for different years. Discount each year's dividends with the required return. So what will happen, as the name suggests, the question will give you the data in such a way that for few years, maybe 2-3 years, they will give you an explicit forecast that this would be the dividend, maybe a constant dividend or specific amounts of dividend. So that's called an explicit forecast period. So different growth rates are forecasted for different years. What you will do individually, you will discount each of these, cash flows to their present value. And horizon period. Now, in this horizon period, the growth returns to a constant rate. Growth returns to a constant rate. Just like we saw constant growth TVM. So here, apply the constant growth DVM approach and discount the value to present value. And value of the share will be sum of the value of phase 1 and phase 2. You will understand this better with the help of an example, but I'll give you some time to experiment. I'm giving you some hints although how to solve. Look at this example. Hitman Company's latest dividend was $5 per share. Latest dividend, that is D0. Please stop making those mistakes, the common mistakes. D0 is not to be used. You'll need to calculate D1. Remember that. Number one. So Hitman Company's latest dividend was $5 per share. It's estimated to have a cost of equity of 8%. Use the DVM, dividend valuation model, to ascertain the value per share of Hitman Company, assuming 3% growth for the next 3 years and 2% growth after this. After this means what? Till forever. That is the constant growth. Are you able to understand that for the first 3 years, you need to take an explicit forecast of the dividends? What would be D1, D2, D3? Giving you an idea. You will need to calculate 5 into 1 plus 3%. Then whatever that value is into 1 plus 3% into 1 plus 3%. You will get the values of dividend for 3 years. Discount them to the present. Okay. And phase 2, that is the explicit forecast period. Phase 2 is what? Apply the constant growth DVM. Now, I'll just give you a hint. P0 is D1 by RE minus G. That's the constant growth DVM. That's the constant growth DVM. See, in the explicit forecast here, you have taken dividends for year 1, 2, 3. You will take the dividends, you will discount them to the present. For the horizon period, tell me, I need to take D1 or it is already taken over here? I don't have to take D1. D1 is gone. I've taken it in the explicit forecast. What will I take here? What do I need to take here? Then is the horizon period starting? When is the horizon period starting? D4? Absolutely right. So let's just change this to D4. Right? RE minus G. Now tell me, will I still get P0 or something else? I get P0 when I use D1. What will I get when I use D4? Be specific. What will I get? I get P0 when I use D1 by RE minus D. Absolutely right. I will get P3. I will get P3 when I use D4 by RE minus G. But I have to find out value of the share today, not value of the share after 3 years. Correct? I need to find out the value of the share today. What will I do? Once I have found out P3, I will discount it. I will discount it to get P0. So, discount P3 to P0. Then, what you will do is the sum of the present value which you got over here. Okay, the sum of these values. And the P0 value of this horizon period. That is the value of your share. Now you read the steps, it will make so much sense to you. Explicit forecast. Different growth rates are forecasted for different years. Discount each year's dividend with the required return. Simple. Horizon period. Growth rate returns to a constant rate. Apply the constant growth DVM approach and discount the value. That is discount P3 to present value. And value of the share is equals to phase 1 plus phase 2. Did you understand? So that is what you will be doing. I've just given you a glimpse of how you can try this one example on your screen. Try this. You may be wrong, but I just want you to experiment. I've already given you the layout. I just want you to experiment with how you would solve this. Give it a try. All right, let's see what you're getting. Manoj and Vishali have tried. Others also, please send in your answers. Let's take a look. The correct answer is 73.73 is the correct answer. Sorry, 87.39%. 87.39, which Vishali has got right. Very good. Please pay attention. Any doubt, let me know. If you're not understanding something, please ask. So, as I told you, we'll have to solve it in two phases. Phase one is explicit forecast period. So, growth is 3%. D0 is 5. So, you'll find out D1, D2, D3. How do I do that? Just explain to you. So, 5 into 1 plus 3%. Then, again on this value, 5.15 into 1 plus 3%, which again further increases. Okay? So, you keep on increasing the dividends. Then, cost of equity is what? 8%. We discount it using this. How do we discount? 1 divided by, say, have a look here. Everyone, please pay attention. See, I'm teaching you something. If you have not done FM from me earlier, this would be maybe new to you. So, what you have to do is, we do 1 divided by, how do we discount? 1 divided by 1 plus 8%, and then raise it to the power of number of years, right? So, raise it to the power of 1. That's how we discount. 1 divided by 1 plus 8%. That's the discounting factor. So, raised to the power of 1. Then, raised to the power of 2. Raised to the power of 3, like that. 1 divided by 1 plus 8% raised to the power of 3. That's how we keep discounting. But what I would suggest is, instead of changing the numbers manually, you can link and save your time. So what you should do is 1 divided by 1 plus 8%. Freeze this cell. You can press dollar signs. You can freeze the cells and raise it to the power of number of years. See, you always write down number of years anyways. Just link it, raise it to the power of number of years here, and drag it across. See, 1 divided by 1 plus 8%, raised to the power of 2, raised to the power of 3. And you get the present value of dividend. That comes as 13.65. Please tell me if it is clear till here. Clear? Yep. Then phase 2. Growth is now constant at 2%. What would be D4? D3 into 1 plus 2%. D3 is what? 5.46 into 1 plus 2%. That is giving you D4. Correct? And you get P3. P3 would be what? D4 by RE minus G. So D4 is 5.57 divided by RE, 8% minus 2%. RE, KE, you can always use interchangeably. Nine 2.88 and phase to P0, 92.88. You'll have to discount it back 3 years. So you can simply multiply it with the discounting factor of 3 years into 0.79. And you get phase to P0, which you can sum up with phase 1 P0 to get the value of the share. This is nothing but value of year 1 to year 3's dividends plus value of year 4 to infinity's dividends. Please take a look at the calculation. Any cell you want me to explain again, please feel free to ask. See, this is P3, 92.88. We need to bring it back 3 years. We need to discount it back 3 years. So we have multiplied it with the annuity factor, with the present value factor here. Just like we multiply here, no? 5.46 into 0.79 to get the present value. Here also we have done this. Please take 2 minutes, observe the calculations. Any doubt, please feel free to ask. Is it clear? Any doubt? So what we have done, in short, I'll tell you, 2 phases, explicit forecast, horizon period. Explicit forecast, discount the dividends separately. You get the P0 for that. Then horizon period, you apply the constant growth dividend valuation model formula and discount it again to the present value. And you add it up to get the value of the share as 87.39. Okay. Now tell me one thing. So these were the basic concepts of the dividend valuation model. If I give you in this formula, if I give you P0, D1, and G. Can you find out cost of equity? Missing figure? You can find out, right? So later, this will become the formula for cost of equity. The same formula we're going to derive later and make it the formula for cost of equity. Come to that later. In the meanwhile, let's solve some small little questions from the book. Activity 2. It is on page number 28 of the book. Page 28 of the book. A company has paid the following dividends over the last 5 years. 2010, 11, 12, 13, and 14. They have given you the dividends. Estimate the growth rate and the cost of equity. If the current ex-dividend market value is $10.5 per share. So you will have to use that formula. P0 is equals to D1 by RE minus G. Your RE would be the missing figure. First, you'll have to calculate G. Using the CAGR approach, you'll have to calculate G. Let's quickly try activity 2. Please try activity 2. Growth should be very simple. And I've already given you the hint for cost of equity. Just need to put it in that formula of D1 by RE minus G. Give it a try. Let me know when you're done. All of you, please try. I'm just seeing few people responding in the chat. Please do it. Let me know when you are done. Activity 2 from the book, page 28. All right, let's see. Okay, Vishali has done it. Raksha has done it. Good work. Let's have a look at the answers. So year 2010, dividend is $1. Then 11, 12, 14. I'm noting down the numbers to explain your concept. 1.1, 1.25, 1.36. Okay. Now, over how many years the growth has happened? Look at this. One. Look at my cursor over here, please. Number one, then two, three, and four. The growth has happened 4 times. Please don't get confused. If the question specifically tells you that the growth has happened over 3 years, 4 years, 5 years, take it as it is. But if it gives you, year-based data like this, be careful. And here you can see that the growth has happened 4 times. From 1 to 1.45, the growth has happened 4 times. So what is the growth rate? 1.45 by 1 raised to the power of 1 by 4, not 5, minus 1. Okay? P0 is given as 10.5. So D1 would be what? 1.45 into 1 plus 9.7%. That is D1. And if you apply the formula here, see, what is the formula we learned? D0 is equals to D1 by RE minus G. Right. So when you solve this, and what you will get is RE is equals to D1 by 0 plus G. When you solve the equation mathematically, this is what you will get. All this D1 by P0 plus G. Simple mathematical solution only I've done, nothing complicated. If you just solve the equation by taking RE to the left hand side, this is what the formula would look like. Okay, so cost of equity is 24.9%. Please take a look at the solution. Anyone having any doubt? Very good, Laksha and Vaishali, you both got it right. Let me know any cell you want me to explain again. Any formula? Okay. The simple calculation, 24.9%. Let's do another simple question. Here also. Now, remember this formula, okay? Cost of equity is D1 by P0 plus G. Cost of equity is D1 by P0 plus G, and P0 is what? D1 by KE minus G. Remember these two formulas. Okay, try this question now. Activity 1, page 27. Mango Limited shares have a market value of $2.2 each. The company is just about to pay a dividend of $0.2 per share, as it has every year for the last 10 years. Calculate the company's cost of equity. Two small adjustments are here, hidden adjustments. Let's see if you're able to crack it. Activity 1. All of you give it a try, please. All right, all of you getting 10%. That's right. So come about to be paid dividend. It means what? That this share price is come dividend. It is come dividend share price $2.2. And dividend is 0.2. So X dividend P0 would be $2. Always remember the computation is done on X dividend prices, never on come dividend prices. So cost of equity. Now it's a no growth case. Why so? Because it was given that the company has been paying constant dividend every year. So cost of equity will be D by P0. Now how did you get that? See, you know the formula. It's P0 DPS by cost of equity. That's what we're doing over here. Just moving KE to the left hand side. And the formula that we get is DPS by E0. Solving it, we get that the cost of equity is 10%. Very well done, Jaya, Praksha, Vaishali. Good work. Sorry. Done. Simple question. Now try another question from the book. Yes, the Excel notes will also be uploaded, but just a disclaimer, once the chapter is over, I share the notes with the team to upload, not after every class. So if a chapter is incomplete, like this one will not get completed today for sure. So once it is completed tomorrow, I'll share across the notes with the team and they will upload it. So mostly you will get it on Monday. Okay, Monday or maybe Tuesday. And mostly they will upload it the next day. So Monday or Tuesday you will get them. But everything that I show you, I work on, you will get that. You don't have to take any photo or anything. You will get all the notes. All right. So activity 3, have a look here now. Apple company has 300,000 ordinary shares in issue with an ex-dividend market value of $2.7 per share. A dividend of $40,000 has just been paid out of the post-tax profits of $100,000. Net assets at the year end were $1.06 million. Estimates the cost of equity. So one hint to you here would be that when you compute return on equity now, that equity balance has to be at the opening value. Because think about it, the opening value which was invested, that was used to generate the profits during the year. Whereas here they have given you net assets. Net assets is nothing but equity only. They have given you net assets at the year end. So be careful about that. You will need to calculate net assets at the beginning to compute the return on equity. Rest everything is very simple. Is this the small adjustment that you have to do? Please try activity 3 on your screen. Small question, but with a twist. Yes, Plaksha. I just saw your message. You'll have to deduct it. The retained earnings of the year, you'll have to deduct. Well done, Vaishali. You've got it right. Others also quickly complete the answer. Okay. See, all of you, pay attention. Any doubt, please let me know. So we have a PAT of 100,000, dividend of 40,000. Dividend payout ratio, therefore, is what? 40%. So retention ratio would be 60%. 40% dividend is being paid out. That means 60% is being retained in the business. So retention ratio is 60%. Now, net assets at year end is 10 lakh 60,000. Ma'am, we are supposed to use equity. Why are you using net assets? Now, I'll just take you to a balance sheet and you will understand that net assets is nothing but equity only. See, this is how, don't look at anything below this. You may not understand now. I'll explain it to you later when the time comes. So, this is how a typical balance sheet looks like, the liability side and the asset side. Equity, always remember, it means equity share capital and reserves and surplus. So, if you see, net assets means what? Total assets minus all the external liabilities. So, if I do 200, which is my total assets, okay, minus the external liabilities. That is what net assets are now. Net assets means what? Assets minus the external liabilities. So what am I left with? Equity. Okay. So nothing to do over here. Just focus on what I've taught you here. That the total of assets and the liability side of a balance sheet match. So equity plus reserves is nothing but, or basically equity. Equity share capital plus reserves. Equity is nothing but net assets. It's just total assets minus the external liabilities. Coming back. So we were given with net assets at year end $1.06 million. If I reduce the retained earnings, how much would be the retained earnings? Total profit minus the dividend. So this would give me the retained net assets at the beginning. Okay. And then rest everything is simple only. Return on equity would be 100,000. PAT by equity, right? So PAT by equity is 10%. G equals to P into R, 60% into 10%, 6%. And cost of equity, it's D1 by P0 plus G, right? D1 by P0 plus G. The number of shares is 300,000. P0 is what? 40,000 by 300,000, that is 0.13. So D1 will be 0.13 into 1 plus 6%. P0 is given as 2.7. And therefore, cost of equity is P1 by P0 plus G. Please take a look at the formula. Anything that you're not understanding here, let me know. Please go through the solution. Please take a look at this. This was the only interesting part which I wanted to discuss. Rest everything is simple in this question. So net assets at the year end were there. You need to reduce the retained earnings to get the net assets at the beginning to calculate the return on. Done? Okay. So on that note, we will be wrapping up our class for the day. We will meet again tomorrow to continue our discussion. Again, we have a lot of interesting topics here as well, like cost of preferences, cost of debt, so that we will continue in our next class. Okay. And yes, again, I'll repeat myself. If you get any doubts, just don't hesitate at all. Please ask me. Right? Thank you. Bye bye, and please take care.